This meeting is being recorded.
Good morning, good afternoon, good evening, whenever you are. This is part 15 of Become cTrader Master webinar series by TopFX. And I'm very happy to meet you all guys with the new webinar. And the topic of this new webinar is related to the technical analysis. What are we going to talk about is the technical indicators. Hopefully some of you know what the technical indicators are, so hopefully some of you maybe are using some sort of the technical indicators. And today I would like to talk about these indicators that every trader should know. So what do we need to do here is to expand our view only for the chart. Then we don't need this one on the bottom either. So let's switch off the trade watch, and now we have the full chart on our screen. So welcome again, and I hopefully I think that hopefully this let's say amount of knowledge I would like to give to you tonight would be beneficial for you in many ways. Indicators are considered essential when trading in the forex market, and some forex traders use the indicators because they allow them to better understand when they can buy or sell in the forex market. And these indicators that I'm going to talk about are known as important part of the technical analysis, and every technical or fundamental analysis should be aware of these indicators. Every trader, every speculator, day trader, long-term trader, swing trader should be aware of these indicators, because they are cream de la cream of many hundreds of indicators built into the trading platforms. And today we are going to use the cTrader platform with some special, of course, special, let's say, appearance of the of a very well-known and beneficial technical indicators. But what are these technical indicators? The technical indicators are part of the technical analysis. What is technical analysis? Technical analysis is a way to interpret the chart by judging the past events and applying the past reaction on the market to the current market conditions. Okay, so we can have the indicator applied to our chart in order to see whether this this situation might be used for our to make profit, even more, let's say, accurate than usual. So how to apply indicator on the chart is very easy. You have to go here on the F, right? This is the icon F, and the pop menu will drop down menu will be on. So what you can see here are the trend indicators. So those indicators are ones that follow the trend and will show you on a particular time frame, of course, when the trend is about to end and reverse. We got the oscillators, and the oscillators are this kind of indicators that are showing you the levels that on the chart that are being considered as extreme levels. For example, that might be extremely overbought or extremely oversold levels. And the oscillators, basically what they do is kind of oscillate up and down, up and down. So there are the cycle indicators. Volatility is another group of indicators that are showing you some sort of the price change on the market and how fast is it change, and when eventually this change might when and where this change might eventually be stopped or reversed. And of course, volume. Well, volume is very easy to understand. Part of the indicator is based on the amount of the transactions, buy and sell transactions that are made on a certain time frame on a particular market, of course. So I'm not going to list all of this because there are plenty of them, and you have the other indicators. Some of them are indicators created by some world famous traders and analysts and the people who are pros on the financial markets. So which is why the other people are trying to apply them as well, with a bigger and lesser success. But what we are going to apply on our chart now is, of course, the sort of the indicators that is a must known. It's something that every trader should know. It's a basics in the words of the indicator. So let's go to the trend here, of course, and let's just apply some very decent indicator, which is called, let me just take a look. Moving average, and I'm trying to find out the simple moving average. There you are. The simple moving average, if you apply it on the chart, this kind of a window will pop out. This is a crucial forex indicator that indicates the average price value over a particular period that has been chosen. So if the price trades above the moving average, it means buyers are controlling the price. And if the price trades below the moving average, it means sellers are controlling the price or the market, right? So what do we have here? We have a couple of different moving averages. For example, as you can see, we got simple moving average, we got the exponential moving average, we got weighted moving average. I guess that you learned about this kind of averages in school during your education. So what I'm going to use is a simple moving average when the source of my data is the close of the candle, right? So the periods I'm going to use on my time frame, it will be 100 periods, and there is no shift in my moving average, which means it will be applied straight to the market. So this is the moving average, and I would like to change my time frame to daily. There you go. So right now, this is a daily time frame chart, candlestick time frame chart, of course. Let me just get rid all of this, let's say, things on the chart that can be a little bit confusing. So let me just remove the positions, and let me remove the orders and price alerts, and that's it. Okay, so let me just remove it from the chart. Past position, and what else do we have? Tick volume, we can remove this one as well. So there's no volume because we will talk about it in the other, during our other meeting. And I think that's about it. We don't need anything else. The grid, the period separators, it's okay. Deal map, we are going to get rid of the deal map, and there you go. We now have a better chart. So blue trend line, as you can see, 100 days moving trend line. So if, according to the definition, price trades above the moving average, it means buyers are controlling the price. So in our situation, buyers are controlling the price unless the price will go towards, let's say, the level of roughly 1.0448. Yeah. So this is the moving average right now for the euro dollar for the daily time frame chart. In trading strategy, a trader should focus on buy trades when the price is trading above the moving average. I'm choosing the 100 days moving average, of course. And if you don't like this kind of an average, you can, of course, do one more thing. You can add another moving average. So let's just switch with this one. Let's say we are going to add another simple moving average. So there you go, I'm changing to simple, and this will be 55 periods moving average, no shift, and different color. This time it will be yellow. And if we apply the yellow moving average, which is a 55 days moving average, so you can see clearly that there is a cross between 155 days moving average, and this cross is very important for the market traders, for the market participants, for traders, for speculators, because it means that the simple moving average of 55 periods is basically crossing to the upside the slower moving average, which is 100 periods. So the faster moving average, yellow, is crossing the blue moving average, which is 100 periods, and that of course is being considered as a bullish signal on the daily time frame chart. So please make yourself familiar with the concept of crossing some kind of lines, because we are going to talk about them later on. So this is the indicator that every trader, one of the indicators that every trader should know. One more very important concept for the traders is, of course, known as the Bollinger Bands. Is based on something which is called a standard deviation. This is the indicator that can be found on the volatility section. If you go here, you can see the Bollinger Bands is ready to be applied. When it comes to measuring the price volatility of a particular market, like in our example, it is euro-dollar, the Bollinger Bands indicator is used to determine the entry and the exit points for a particular trade. So Bollinger Bands, as you can see, will come with the three parts: the upper, the middle, and the lower bands. So these bands are often used to determine overbought and oversold conditions. The best part of this indicator is that it helps characterize the price and the volatility over time, over a time of a financial instrument, over a time of the Forex pair. So what do we have here is, of course, some kind of a window when we have to input our preferences. So we are going to use the source of the close of the candle, right? So the price that we are going to apply the indicator is the close price. Period is 20. That's the standard period, so don't change it. You can leave it like this. Standard deviation is 2. So I will tell you what it is definitely, and you can see that the top band will be, let's say, this color. The bottom band will be this color, and the middle will be orange. And this is our Bollinger Band indicator. So let's just apply it. And as you can see, something interesting is going on here. Basically, the way to trade the Bollinger Band is to enter or exit when the Bollinger Band is touching the upper band, the middle band, or the lower band. So right now, as you can see, the newest data are showing us that the market is moving between the middle and the lower Bollinger Band. So that's the middle, that's the one standard deviation, okay? That's the middle, that's the another standard deviation. So all in all, you got 2 standard deviations from the middle price. Right now, we are trading below the middle price. We are trading lower and lower, close to the lower Bollinger Band, because this is of course the distance that needs to be covered by the market in order to hit the one standard deviation. In the past, as you can see, when the market hit the upper line here of the Bollinger Band, it went down in 4 days, hitting the lower band. As you can see, then on the 5th day, we got this big green candle, and then we are going towards the upper bands, and we're trading closer and closer and closer towards the upper band on above the middle line. So it is showing you basically very, very nice period over time, right? But it's not only Bollinger Bands are not only about the price, but about the time as well, during which the market is trading and it's being controlled by either bears or in that situation in bulls, right? So this market is being controlled by bulls as long as it hits the upper Bollinger Band, or it will reverse below the middle band. Okay, so now let's switch it off and let's go to another very interesting indicator. Let me just apply it on the chart first. What we are going to talk about is the, let's say, oscillator. I'm trying to find out this one, volatility. There you go. This is average true range. This indicator, let me apply it on the chart. For the daily time frame chart, we want to use the average true range of the 14 days back. Okay, this is a daily time frame chart, so we are looking 14 days back. As you can see, let's just apply it on the chart. And what it says, this ATR indicator is used to measure the market volatility again, but you know that already. The key element in this indicator is the range and the distinction between the periodic low and high, which is called, of course, a range, right? The range of the market trades, basically. The range can be applied on basically any trading period. It doesn't matter. I'm using it on a daily time frame chart. In the average true range, there is a use of the true range basically, and this is the biggest of the three measures, right? So the biggest of the three measures of current high to low period. The second is a previous close to the previous high period, and the third measure is a prior close to the current low period. The absolute value of the biggest of the three ranges is called the true range. So, however, the average true range is the moving average of a specific true range values, basically, right? So, what we have here is a kind of a range of the market that is being traded over a particular period of time. Right now, you can see that our true range is very, very low. It comes from the higher levels, like this one, okay, and then it goes and goes lower and lower and lower. As you can see, there was an increase of the trading range here, which is why this period of the up movement on the indicator has happened. There was an increase in average true range traded by the market daily here, for example, right? And as you can see, there was kind of an increase of the average true range here, which is why these indicators went straight up. But right now, as you can see, we trade only the trading range, for example, from the current high to current low period is very, very narrow, very low, very low, very low. It is trending lower, but this is not what the average true range is showing you. The average true range is showing you the current, for example, high to low period, and if the volatility is kicking in or not. As you can see right now, average true range is very, very low, for example. So that means basically that you shouldn't expect a big moves to come to this market soon, because the volatility and the range are getting smaller and smaller. So let's just remove this market from the this indicator from the market. There you go, it's off. And let's talk about one of my favorite ones. One of my indicator that is my favorite. This is in oscillators. You can find it in oscillators, and this is, of course, where is it? There you go, MACD crossover. And MACD stands for moving average convergence divergence, or MACD. This is one of these indicators that tell the force that is driving in the forex market. In addition, this indicator helps identify when the market will stop in a particular direction and will go for a correction, for example. So right now we're moving down, so maybe we can identify when the market will be able to reverse, for example, to the upside for a pullback or maybe for a correction. MACD is arrived by is arriving at by deducting the exponential moving average of the long term from the short term EMA. So this is basically everything about the moving averages. So for those of you who don't know what is the exponential moving average, so let me just quickly give you some sort of the explanation. So exponential moving average, or EMA, is a kind of a moving average, okay, where the current data gets larger in importance. The newest data gets larger in importance than the older ones, okay? So the formula for the MACD is 12 period EMA minus 26 period EMA. As you can see, we got 12 or 13 periods. We are going to use 12 periods short cycle. So that's the short EMA, long cycle 25 cycle, and the signal line, which is 9 cycle. And let's just apply it to the chart so you can see what do I mean. So we got the long-term EMI, short TMI, let's say, and of course the histogram. So right now, as you can see, let's say this point here, as you can see, this point here, this is the point when the short breaks below the long-term EMI, and that's the signal to, of course, go short. Okay, so then as you can see, we got our last burst to the upside, but on the EMA there is no breakout to the upside. EMA, just the short one touches the longer one, and then it moves lower and lower, going away from the let's say longer time period exponential moving average. And as you can see, the price keeps moving lower and lower and lower. And on the histogram, this space here between red and the yellow moving averages is being shown on the histogram. So right now, this distance between those two moving averages is very small. As you can see here, yeah, there's almost no distance here, so the volatility is low, of course, and stuff like this. So you can combine these two indicators, and now when it goes lower, it's like there is a drop in distance. Distance is even bigger distance, steady big distance is between the both of the exponential moving averages. So what we are looking for in this indicator is the cross. Again, it's a cross of the shorter, let's say, moving average, shorter periods moving average to the longer periods moving average. Very helpful indicator for the forex traders. Okay, so that was the MACD, and the other one that I would like to show you is, let me just find it on this on this menu, because I don't want to make any kind of mistakes. You can see it clearly that this indicator is a relative strength index, and I think it will be either trend or the oscillator. Where is it? Trend or oscillators. Okay, so you go to oscillators, relative strength index. Let's click on it, and what do we do here? We do not change anything. Periods 14 days backwards. These indicators looks 14 days backwards of the daily close price. Okay, so let's just apply it. So this is another forex indicator that belongs to the oscillator category, and it's known to be the most commonly used forex indicator ever. Okay, RSI showcases an oversold, which is above the oversold is below the level of 30. Okay, so that's the level of 30. Let me just move it. Okay, below the level of 30 is oversold, and overbought, which is above the level of 70. Okay, so overbought or oversold market conditions. Okay, and it's of course the temporary state of the markets. In our example, we applied this RSI indicator to the daily time frame chart. So again, the value above the 70 shows the extremely overbought market conditions, and the value lower than 30 shows the extremely oversold market conditions. Sometimes several traders use the levels of 80 and 20, right? And basically those conditions, of course, those trading conditions, of course, happen to the can happen in the forex markets and the other markets. Nevertheless, the default value is 72 to 30. So what you can do here with this indicators is basically the relative strength index is showing you the pace of the changes in the certain direction of the particular market. For example, in our case is the euro dollar on a daily time frame chart. So as you can see, let me just zoom out a little bit so you can see it clear. There you go. As you can see from that low, for example, you have, there you go, the level of 30 is here. So you know that this is extremely oversold level. Okay, so the market goes very, very rapidly down. The indicator points down very sharply, breaks the level of 30, goes towards the level of how much is it? 25 points. So that conditions are extremely oversold, which means that market is in over the influence and control of bears. However, right now, this price that is right now on the euro dollar, for example, let's say the price of, let's say, close of this candle 9,595 pips is very cheap compared to 14 periods back, which is why this level here is being considered as an extremely oversold. So market is oversold because everyone keeps selling and selling, and of course if someone is selling, someone must to buy. So we got this reversal here from the extremely oversold conditions, and the momentum to the upside rises and the market rises as well. We got a pullback, but there is no new oversold condition, so it stopped somewhere here at the level of 40, and another shot to the upside, and the momentum goes to the upside, and the price goes into the upside. Correction again, another movement to the downside, and sharp movement to the upside. And when the market is trending even towards the levels that we know right now, of course, 1 point, let's say 10 and 20, for example, this indicator stays close to the level of 70, close to for being overbought. Sometimes goes for a pullback towards the level of 50, which is the neutral level that separates the positive territory from 50 to 70 or 80, from the negative territory from 50 to 30 and 20. So of course this territory is controlled by bears, the upper territory is being controlled by bulls, which is why with that nice strong steady momentum the market can rise higher and higher and higher, pull back higher and higher and higher, and then when it finally touches for the fourth time the extremely overbought market conditions, there is new high made here. For example, if we consider this high, there will be another high, another high, another high, but the market, as you can see, doesn't do it anymore, doesn't do higher highs, higher highs, highest highs. It stays at the very same level, around the level of 70, which means there's divergence between the prices and the oscillator, and we reverse sharply lower as the bears enter the market, because the market is extremely overbought, which means it is way more expensive than 14 days ago. Okay, and of course this is a cyclic indicator, so it moves in cycles from extremely oversold to extremely overbought, from extremely oversold to extremely overbought, from extremely oversold to extremely overbought, and so on and so on and so on, occasionally trading in a certain direction. For example, in our situation, for this period of time the market has been trading to the upside because of this nice strong bullish momentum, as they call it. So that's the RSI indicator. And of course, we need to assume that one more oscillator is always welcome. So what we are going to talk about is the oscillator that is being called as a stochastic. Okay, the stochastic oscillator is considered one of the top forex indicators that help traders basically to identify the momentum and identify overbought and again oversold zones. It's easier to use than the RSI. Nevertheless, of course, it provides different kind of information. So as you can see, what do we have here is the %K periods, which is the longer period, %K slowing, which is the free periods now, and the % of D periods, right? Okay, so all of these inputs, there's a lot to talk about. Then what I want to show you is that the current situation with the stochastic indicators with these settings is looks like this. Okay, so it might be kind of a confusing. All right, so what we are going to do is to change the settings for you to explain how the extremely overbought and oversold conditions looks like. So what we are going to look at is 21 periods of the %K here for the periods. There will be 13 periods here and 9 periods here. Okay, so the simply moving average stays, and let's just apply this to the indicator, and now there's completely different kind of a indicator. As you can see, we can move from again the levels of 20 and 80, so extremely oversold, extremely overbought, and we can move from the downside to the upside, and again to the downside, and again to the upside. And this, of course, red line, which is the let's say longer longer period line, and this blue line, which is a shorter period line. Every time they let's say they cross, they are sending the signal for the traders. Of course, sometimes the signals are better, sometimes the signal are worse, but this one was a particular very nice signal. As you can see, the slow line keeps moving higher, keeps moving higher, keeps moving higher, oscillates around the level of 80. The red line is moving up from the extremely oversold conditions towards the extremely overbought conditions. Very nice signal here. Then we have the dip. Of course, this dip here is here on the chart. As you can see, very nice signal here. And then again, we have the signal to buy when the blue crosses the red. So that's the signal to buy, and we can, of course, go as high as this is 1.1030, and this is signal to sell. And as you can see, since then, nothing happens yet with the signal. So there is no new signal being produced by this indicator. So we got all of these signals that were made before they were done, and the newest one was sell signal, because the short-term period line crosses the longer period line, and for now we are just away from each other, of course, which means the market keeps moving lower, keeps moving lower, keeps moving lower. Shorter line hits the level of 20. Now it's trading somewhere around the extremely oversold conditions. The longer line approaches level, so we can assume that around this area here, 1.0523, 1.0883, we should assume that this area will be considered as the extremely oversold area. Okay, so the market will possibly hit this zone here, and the stochastic oscillator should do this again. So it should bounce from the extremely oversold conditions towards the extremely overbought. It might do it in a sharp way, very strongly, like here during this, well, decent sell-off, let's call it by name, or it can do it you know, with a more steady manner, doing one step at a time, one step at a time, one step at a time towards the highest higher price levels. Okay, so this is another very interesting indicator for all of the forex traders that want to apply the technical analysis indicators into their strategy. Now, what I'm going to show you now is an indicator, but it's not being it's not being used. Okay, let's remove all of the indicators. We don't need them at all. Okay, what I'm going to show you is another kind of an indicator, but it's not you know, the one that you should that you would expect you know, to be applied on the chart, because it won't be in the window below, it won't be extremely oversold, extremely over, but it will be something quite different. But it is so popular that I need to mention it, and because it's so let's say the use of this indicator is so vast that we cannot cover it during one of the let's say webinars. Okay, so this, of course, this let's say indicator, it's here, and it's called Fibonacci. As you can see, the Fibonacci has a, let's say, a Fibonacci retracement, Fibonacci fan, Fibonacci time zones, Fibonacci arcs, and Fibonacci expansions. What we are going to talk about today at the end of this webinar is Fibonacci retracement. It's an excellent Forex indicator that basically shows you the exact direction of the market, and it is the golden ratio called 1.618. Forex traders use this tool, use this indicator to identify areas and reversals where profit can be taken very, very easily. So this is being used for to identify certain levels, okay? The Fibonacci levels, this is how they are called. I computed once the market has made a big move up or down, and it looks like it has flattened out at some specific price levels, and it's bouncing, for example, from this level. So the retracement levels, and retracement is something we are going to talk about. So retracement levels, let me just show you guys on the chart. For example, let's say, okay, let's say here. So from that top, where's my bottom? My bottom will be here somewhere. There you go. This is swing bottom. So these retracement levels here, these purple lines on the chart, are plotted to find areas to which markets may retrace before moving back to the trend that the movement is in the first price has created. Okay, so what I'm talking about is that we have this movement to the upside, and the retracement levels are telling us how deep the market will go to the downside before it will continue to move up again. One of the most important Fibonacci retracement levels are 38%, 50, and 61.80%. So those are the most popular. Other popular retracement levels are 23.60% and 76.40%. Okay, so for example, for you to understand why I have applied this on my chart right now, is because I have this up move here, and now I want to know how deep the market's gone to the downside, possibly how deep it will go towards what of the Fibonacci retracement levels it will go, because as you can see, you got the level here 1.0464, 1.0283, 1.0106, for example, right? Three the most important levels for the daily time frame chart of the euro dollar, and the market might hit any of them and then reverse. For example, it can hit 50% and then flatten, and then maybe there will be some kind of a candlestick pattern, and then reverse to the upside. Why? Because it wants to continue the initial cycle, and the initial cycle is to the upside, basically, right? So that's what I want to find out. Where can I enter the market if I want to go long, to ride the trend for, in our situation, to the upside. So this is how the Fibonacci retracement tool is being used in the market by the market participants. I won't tell you guys anymore because I want to save this for later, for another webinar, when I can go into the details with the Fibonacci retracements, and of course with the Fibonacci fan, Fibonacci time zones, Fibonacci arcs, and Fibonacci expansion. There are different tools based on the golden ratio, of course invented and discovered by the Leonardo Fibonacci in his book Liber Abaci, in the I think it was like hundreds of 500 years ago. I guess it was Middle Ages, long time ago. And basically the idea behind all of these tools is the same. Basically, how deep in price and sometimes in time the market must go towards certain levels. Yeah, must the market go before it will be ready to continue the trend, either to the upside or the trend possibly to the downside, of course in a different example, in a different situation. Okay, so that's the Fibonacci tool. In my situation, I was talking about the Fibonacci retracement. Okay, guys, I think I gave you at least 6 or 7 indicators that every forex trader should know. Come on, guys, this is something for the for every forex traders. You're supposed to be aware of the existence of this indicators. It doesn't matter if you use it or not. You must know that other traders are using this to the sometimes even extreme levels. So if you want to apply any of the indicators, just recap. You click here, you go for the trend, oscillators, volatility, volume, or other indicators. As you can see, there's plenty of them, but I was talking about this one, who are the most popular, and it's shame not to know them, not to know how to apply them on the chart. Or eventually you can of course do something with the Fibonacci tools that are possible to apply from this drop down menu on the cTrader trading platform. That's everything for me for today. Thank you very much for watching this webinar. I hope we are going to see each other next week with another topic, with another very exciting webinar from the Become the cTrader Master series. Thank you very much for the participation. Have a nice week, guys. Hope to speak to you soon. So for now, take care and bye-bye.